You're listening to a production of the National Media Archive. To learn more or volunteer, go to nationalmediaarchive.com.
Hey everyone, Darius here. Have you ever wondered how borrowing money could actually make you richer? Sounds backwards, right? But let me flip the script. What if you could use someone else's money to build wealth while your own cash keeps working for you in the background? This is where financial leverage comes a fancy term for using borrowed funds to amplify your investment returns. Think of it as a seesaw. When you borrow at a low rate and invest at a higher one, you pocket the difference. That's called arbitrage, and it's the bread and butter of smart investors. Now, you might be thinking, but isn't borrowing risky? Sure, if you don't do it wisely, but when managed carefully, leveraging can turn small streams into rivers of income. So today, I'm breaking down how borrowing specifically through life insurance can be a game changer for building passive income. Let's dig in. Stick around, because by the end, you'll see why your money should never be sitting idle and how to make every dollar work double time for you. Let's set the stage. When you need cash, where do you turn? Maybe a bank, a 401 withdrawal, or even that generous cousin. But what if I told you there's a way to borrow from yourself, pay yourself back, and keep earning interest at the same time? This is where whole life insurance loans shine. Unlike typical loans, you're tapping into your policy's cash value. Think of it as borrowing from your future self, not a bank. The technical term here is cash value accumulation. Now, some of you are probably asking, doesn't taking out a policy loan reduce my insurance coverage? Great question. In reality, your policy stays intact and keeps compounding, even while you use the borrowed funds. Compare that to rating a 401 clause. You lose growth and get hit with penalties. With life insurance loans, your money keeps spinning in two places at once. So why settle for one income stream when you can create two with the same dollar? Let's see how this works in real life. Here's a term you'll want to remember: arbitrage. It's the art of profiting from the difference between two interest rates. Think about IT. If you borrow at 5% and invest at 10%, that 5% gap is pure profit. Let me give you a quick analogy. Imagine buying apples at 1 and selling them for 2. The profit or spread is what investors chase. With life insurance loans, you're doing this with money instead of apples. Now, you might wonder, is it really that simple? Well, there's always risk. If your investment returns drop below your borrowing cost, you could lose money. But with strategic investments, the odds are in your favor. This is why understanding interest rate arbitrage and compound growth is crucial. These aren't just buzzwords, they're your ticket to smarter wealth building. Ready to see how this plays out with real assets? Let's talk about using borrowed funds for rental properties. Picture this. You use your life insurance cash value to buy a rental property. Instead of jumping through bank hoops, you're your own lender. Sounds empowering, right? The technical terms here are cash out financing and rental yield. By leveraging your own capital, you sidestep strict underwriters and keep your investment timeline flexible. Now, finding a good rental property isn't passive at first. There's upfront legwork researching neighborhoods, screening tenants, handling repairs. But once set up, the steady monthly rent can cover your loan payments and still leave you with profit. Some of you may ask, isn't managing a property a headache? Absolutely, but with property managers or short-term rentals, you can automate most of the process. The best part? Your insurance policy keeps earning interest while your new rental pays you. That's double dipping, and it's a cornerstone of generational wealth. Let's talk about scaling up. Real estate crowdfunding. Ever wish you could invest in big-ticket properties like hotels or apartment complexes without millions in the bank? Crowdfunding platforms make it possible. Here, you join a pool of investors, each contributing a slice of capital. The critical terms are fractional ownership and syndication. You get access to larger, often more stable, investments with less personal risk. Now, you might wonder, what's the catch? Well, returns aren't always instant, and you need to research platform credibility. But the upside is learning from experienced investors and diversifying your portfolio. I remember my first Hotel Delmy share was a drop in the bucket, but the learning and returns were tremendous. That's the power of leveraging community capital. Using your life insurance loan here means your cash never sleeps. It's multiplying behind the scenes, while you build wealth alongside industry veterans. What if you could flip the script and become the lender? That's peer-to-peer lending in a nutshell. Platforms like Lending Club connect you with borrowers needing personal or business loans. The buzzwords here are principal, repayment, and interest margin. You set the term's interest rate, repayment schedule, and watch your money generate returns, just like a bank does. Skeptical? You should be. Default risk is real, so spreading your loans across many borrowers called diversification is key. But with due diligence, returns can outpace what you'd earn at the bank. Let me tell you, seeing your loan payments hit your account every month is empowering. It's passive income with a purpose. By using life insurance cash value for peer lending, you're stacking the deck, earning from your policy and from the interest paid back by borrowers. Ever dreamt of owning a business but not starting from scratch? Business acquisition lets you buy into existing, profitable companies. Think cash flow acquisition and turnkey business, two game-changing concepts. You use borrowed funds from your life insurance to purchase a company that's already generating income. Instantly, you're the owner, reaping the rewards without the startup grind. Some of you might ask, but isn't buying a business expensive? Absolutely. But with creative deal structures like earnouts or seller financing, you can minimize upfront costs. I know someone who bought a laundromat with policy loans now. The machines spin and so does the cash flow 24/7. This is next-level passive income. You're not just investing. You're acquiring assets that work for you while you sleep. Let's shift gears to the stock market. Dividend investing is as hands-off as it gets by shares of companies that pay you a slice of profits regularly. The technical terms? Dividend yield and market exposure. By borrowing against your life insurance, you can build a portfolio without draining your savings. Your borrowed funds buy the stocks, and the dividends roll in each quarter. Sure, stock prices can swing, but blue-chip companies think Procter, Gamble, or Coca-Cola have decades-long histories of paying out dividends, rain or shine. Now, you might be thinking, isn't this risky if the market drops? That's why diversification matters. Spread your investments across sectors, and you'll soften the bumps. Dividend investing is the ultimate set-it-and-forget-it passive income play, and when you fund it with borrowed money, your own capital keeps compounding elsewhere. Let's zoom out for a second. What's better than one stream of income? 5 or 6? Diversification isn't just a buzzword, it's your safety net. By spreading your borrowed capital across rentals, peer-to-peer lending, businesses, and dividends, you reduce your risk. One engine stalls, the others keep humming. You might ask, isn't it complicated to manage all these? Here's the secret: automation. Set up auto payments, hire managers, use robo-advisors for dividends. Technology turns complexity into simplicity. Let me tell you about Carmen Shea. Started with one rental, added peer lending, then a dividend ETF. Now her passive income covers her living expenses and she spends her days mentoring others. It's not about working harder. It's about working smarter. Multiple streams make your wealth resilient and your life flexible. So you're ready to dive in. Where do you start? First, audit your resources. Do you have a whole life insurance policy with cash value? If not, research options and get advice from a trusted agent. Second, set clear goals. Are you after monthly cash flow, long-term growth, or a mix? Your strategy may change, but direction is key. Next, compare borrowing costs. If your policy loan charges 5% and your target investment averages 8%, that's a green light for arbitrage. Finally, take action. Start small, learn as you go, and don't be afraid to ask for help. Passive income isn't a magic bullet, it's a journey, and every step multiplies your financial freedom. Remember, money is meant to move, not gather dust. Use it wisely, and you'll own your lifestyle instead of renting it from someone else.